हेलो साथीहरु नमस्ते वेलकम अल अफ यु टु माई च्यानल आजको डिस्कसनमा हामीले चाहिँ इन द कन्टेक्स्ट अफ क्यापिटल बजेटिङ हाउ कुड वी एस्टिमेट द क्याश फ्लो फर्स्ट र यो टपिकमा जानु अगाडि लेट मी क्लियरिफाई अबाउट व्हाट वी मीन बाई क्यापिटल बजेटिङ क्यापिटल बजेटिङ इज अल अबाउट you are going to allocate your funds in the long term capital assets, you can say that. And basically हामी के गर्छौं भने we need to identify the project first of all. So once you identify the project, then we have to evaluate, or you can say that we need to analyze the project whether that project is financially viable or not. Then lastly we would be selecting the best project. This is all about the background of the capital budgeting. Now before selecting the capital budgeting principles and the tools of the capital budgeting, you need to discuss here. Like your capital budgeting decision is the long-term investment decisions, and before making investment we have to analyze all the investment alternatives clearly, and accordingly you could manage your portfolio as well. Now what could be the classification of the project? Because when you are going to take the decisions, then you need to understand the different type of project. For example, let's me clarify about your replacement project. Sometimes like in a manufacturing company, if your existing machine is not working properly, then to increase the efficiency in the productions you might replace the existing one with the new one. That is the replacement project. Or example, an expansion project could be like your Walmart opening a new retail in the new market. When you believe that there is the good market, then you would like to expand your project. That is your expansion project. Now independent project is all about your, if we say, the installation of the brick factory and the installation of the sugar mill. These two examples we can say that independent project, like your cash flow of the former project do not affect the cash flow of later one. And the fourth one is that your dependent project. Dependent project is all about the cash flow of the one project will affect the cash flow of another project, like your construction of the dam and the canal in the irrigation project. That could be the example of dependent project. And the fifth one is that the mutually exclusive project, like if you are using labor intensive project machine, then you cannot use the capital intensive automatic machine for your productions. That means you would have a one choice: either you can use the labor intensive or capital intensive highly automatic machine for the productions. And the sixth one is the diversification project is all about when you try to reduce the risks, then it would be good to invest in different area so that you could manage your risks by using the portfolio applications. Now let me clarify about basic principle of the capital budgeting here. That source is your CFA issued. First one is that decisions are based on the cash flows first. Then timing of the cash flows is crucial. Cash flows that we consider while taking capital budgeting, cash flows are incremental, and we would be consider that cash flow based on the after tax basis. Remember friends that financing costs are ignored. Reason is that when you are discounting the cash flow to find the present value to take decisions, then you would be discounting using the cost of capital, and definitely financing cost would be captured while calculating the cost of capital. That is the basic reason we have to ignore the financing cost while evaluating the capital project. Now what could be the step for cash flow estimation? Today I will be just conceptualizing the concept here. In coming videos I will be discussing about the whole process of estimating the cash flow. First one is that you need to estimate your initial investment, which is also known as net cash outlay. That is the total cost of new machine plus minus working capital. For example, if there is an increase in working capital, then that is the cash outflow example, that is the minus. If there is a decrease in working capital, this is the plus, that is the cash inflow. Plus is the cash inflow. And sometimes the government provide you intensive to the factory. If they invest as per the government prioritized area, then they would provide the incentive, that in terms of your investment tax credit, This is simply the cash inflow to the company. And next one is that cash salvage value of the old machine, or you can say that old assets. And the plus minus tax is all about when we have a gain, I mean to say that you are comparing cash salvage value of the book value. If your cash salvage value is greater than book salvage value, then there would be the gain, and when we have a gain we have a tax liability, and that would be the minus, friends. Okay, but at the same time, when cash salvage value is lower than book salvage value, then in that case you would have a loss, and there would be tax saving. Then tax saving, you could use the plus sign here. Now second step is that you have to find the annual differential depreciations. That for example, you could use the straight line approach, then other approach of finding depreciation as for the given questions. Then simply what we do here, depreciation new machine minus old machine depreciations, that is the second step. Now third step is that you are going to find your annual cash flow after tax. Okay, now annual cash flow after tax is that simply you can say that earning before depreciation and tax minus depreciation 1 minus t plus depreciation. We have to add back the depreciations to find the annual cash flow after tax. This is our third step. Now fourth step is that you are going to find the final year net cash flow. Then final year net cash flow is that net proceeds plus minus working capital. Remember, if you are using your increase in working capital minus, then this will be plus here, because you are expecting that investment in terms of working capital for which you have to invest, and you expect that would generate the cash flow at the end of the year. That is why whatever you did here for the working capital, increase or decrease, you just do reverse here. Now annual differential cash flow after tax, that you just calculated in the step 2, and this way you could find the final year cash flow after tax. Here the net profit is that simply you can say that net profits difference cash salvage value plus minus tax. Tax calculation is the same as I discussed during your explanation about the initial cash outlay. Okay friends, basically what I discussed today is all about how we estimate the cash flow, and basically we are looking for incremental cash flow. We are not going to consider any financing cost. Reason is that your cost of capital, that you are going to discount the future cash flow to find the present value, and you exclude the initial investment to find the net present value. For example, your financing cost already captured by the cost of capital calculation. That is the basic reason we exclude the financing cost while taking the capital investment decision, friends. Okay friends, these are the things that I would like to share today. If you like this content, please like, subscribe, and also share this channel. Thank you all of you for watching this video. In coming days, I will be discussing the whole calculation process by using Excel. Thank you.